By early 2026, the United States government quietly became the largest state holder of Bitcoin in the world.
Which is still just wild to think about.
Right. I mean, the traditional banking system didn't destroy the Wild West of digital assets. It was basically forced to merge with it.
Yeah, they had no choice, honestly.
So welcome to today's deep dive. We are looking at a stack of incredibly dense but really fascinating sources today. We've got legislative texts, macroeconomic projections, and some heavy industry analysis.
All covering that massive 2025 to 2026 regulatory shift in U.S. digital finance.
Exactly. And our mission today is to explore how two monumental pieces of legislation, the Genius Act and the Clarity Act, how they fundamentally rewired the global financial system.
Because we really moved from this reactive, kind of ad hoc legal battlefield into a highly structured, permanent framework. And this transition isn't just confined to, a niche sector of tech enthusiasts or crypto bros anymore.
No, not at all.
The implications of these two acts bleed into institutional capital flows, commercial bank lending, the global hegemony of the U.S. dollar, and ultimately the operational baseline for autonomous artificial intelligence.
So what does this all mean for you? To map out where we are now, we kind of have to establish why the pre-2025 landscape was so chaotic.
Oh, it's a mess.
Yeah, for years, the U.S. operated under what the industry called regulation by enforcement. The SEC and the CFTC were just locked in this endless jurisdictional turf war.
Right, and they were primarily using the 1946 Howey test to define digital assets.
Which honestly always blew my mind.
I know. I mean, the Howey test was originally designed by the Supreme Court to evaluate investment contracts in, of all things, Florida citrus groves.
Citrus groves, you literally can't make this stuff up.
Yeah, and a core tenet of that test relies on an expectation of profit derived from the efforts of a third party. But when you attempt to apply that exact logic to distributed ledger technology, the mechanics just completely break down.
Because the defining characteristic of a mature blockchain is decentralization.
Right. Exactly. There is no central management team or distinct third party. There's just open source code and a distributed network of independent validators. So trying to cram that technological reality into a 1946 legal framework resulted in massive friction.
People were just guessing.
Literally guessing. Market participants were essentially operating in the dark, building multi-billion-dollar platforms, and only discovering they had crossed an invisible line when they received a subpoena.
Instead of giving developers and businesses clear statutory parameters, the agencies regulated through retroactive lawsuits. And that ambiguity was just paralyzing.
It was, and that is exactly where the Clarity Act, the Digital Asset Market Clarity Act of 2025, comes in.
Right, because it abandons the attempt to fit decentralized software into the Howey test entirely and introduces this mechanical sorting system called the tripartite classification framework.
Yeah, the tripartite framework functionally divides the digital asset ecosystem into three distinct legal lanes, which finally ends that binary security versus commodity debate.
So walk us through those lanes. The first one is the digital commodity, right?
Correct. An asset falls into this bucket if it passes the bill's decentralization threshold. This basically means the network is demonstrably autonomous and no centralized group controls the code or the market functionality.
And spot markets for these assets fall under the exclusive jurisdiction of the CFTC.
Right. Then the second lane is the digital security, which is where centralized control still exists. So if a founding team is actively developing the project, and their efforts are the primary driver of the token's value,
it remains an SEC-regulated security.
Exactly, requiring all the rigorous financial disclosures you'd expect. But the crucial innovation in the Clarity Act is the transition mechanism between those two states, which they call factual maturity.
I look at this mechanism kind of like a chemical phase change. An asset might start out as a liquid, a digital security that's heavily concentrated and managed by a core team.
Right.
But over time, as the blockchain network grows, distributes its tokens, and decentralizes its governance, the asset hits that threshold of factual maturity. It essentially evaporates into a gas, becoming a decentralized digital commodity.
That's a great analogy. The framework allows issuers to file certification to officially transition out of strict securities disclosures once that phase change occurs. And that off-ramp is the precise legal certainty the market was starting for.
It's like painting the lanes on a highway that used to have no signs. Oh, and the third lane.
The third lane simply cleans up the remainder, the ancillary utility token. These are tokens used exclusively to access a specific platform or service. Because they possess no investment characteristics at all, they're explicitly exempt from standard securities registration.
By replacing enforcement actions with this mechanical sorting facility, the macroeconomic projections we're looking at in our sources are just staggering.
Oh, they're massive.
Analysts estimate this clear framework will drive a 68% year-over-year decrease in SEC actions. Because institutional capital doesn't necessarily flee strict rules, it flees unpredictable rules.
Right, capital wants certainty.
Exactly. With legal certainty established, projections point to a $2.4 trillion institutional capital inflow over just a 5-year window.
But a capital inflow of that magnitude requires an incredibly secure, frictionless base layer to settle transactions. Traditional correspondent banking is just too slow and fragmented for blockchain-based capital markets.
It takes days to clear a transaction in the legacy system.
Yeah, which is completely unworkable here. And that structural necessity forces us to look at the second piece of legislation, the Genius Act of July 2025.
Okay, let's unpack this. The Guiding and Establishing National Innovation for U.S. Stablecoins Act. While the Clarity Act categorized the broader market, the Genius Act targeted the digital dollar directly.
Right, by implementing the Permitted Payment Stablecoin Issuer Framework, or PPSI, we are talking about codifying stablecoins as a national payment infrastructure by forcing them to operate as narrow banks.
So no more Wild West for stablecoins.
Exactly. The law strictly prohibits the fractional reserve multiplier effect. A traditional commercial bank might hold, a fraction of its deposits in reserve while lending out the rest to generate yield.
But the Genius Act entirely bans this practice for stablecoin issuers.
Completely bans it. Every single token in circulation must be backed one-to-one by high-quality liquid assets, or HQLA.
Meaning physical cash, short-term U.S. Treasuries with maturities of 90 days or less, or insured bank deposits.
Right. Furthermore, the issuers are legally prohibited from paying out yield or interest directly to token holders.
And once Congress poured that foundational concrete, it triggered a massive structural shift in the industry, starting what our sources call the 83-day sprint at the Office of the Comptroller of the Currency.
Yeah, between late 2025 and early 2026, there was this frantic race to secure national trust bank charters. The convergence of applicants was totally unprecedented.
You had crypto-native firms like Circle and Ripple applying for de novo charters to build federally recognized entities from the ground up, right?
Yeah, and tech infrastructure giants entered the fray too, with Stripe applying through its Bridge subsidiary. But the ultimate validation of this new system was traditional Wall Street heavyweights jumping in.
Right, like Morgan Stanley.
Exactly. Morgan Stanley filed for a national trust bank charter specifically to establish Morgan Stanley Digital Trust.
So you have these new digital entities suddenly acquiring the prestige and federal preemption of a national bank charter, operating right alongside legacy institutions. And traditional commercial banks, represented by the Bank Policy Institute, were absolutely furious.
Oh, they were livid. This raises an important question about fairness. They labeled these new competitors Franken-charters.
I have to play devil's advocate here, though. Doesn't traditional finance have a legitimate grievance? I mean, these narrow bank stablecoin issuers aren't mandated to provide FDIC insurance, and they don't have to comply with the Community Reinvestment Act. Isn't that kind of an unfair shortcut?
The legacy banks have a highly valid argument regarding regulatory arbitrage there. Traditional institutions carry massive compliance overhead to serve the broader economy, like funding mortgages and small business loans.
Right. They have civic responsibilities.
Exactly. They view these digital trust banks as cherry-picking the benefits of federal oversight without shouldering those civic responsibilities. And the catalyst for this outrage was a very quiet regulatory maneuver by the OCC.
What did it do?
They amended a rule known as 12 CFR 5.0 to explicitly authorize national trust banks to conduct non-fiduciary custody.
Ah, okay. Because in the digital asset space, custody is almost entirely non-fiduciary.
Right.
The custodian secures the cryptographic private keys for a client, but they have no discretionary power over how those assets are invested.
Right. So by officially designating non-fiduciary custody as part of the business of banking, the OCC opened the back door. It allowed these crypto-native firms to operate at a federal level, fully integrating with the U.S. banking system without actually acting like traditional banks.
It leveled the playing field for the digital asset industry, but the commercial banks argue it simultaneously tilted the playing field against them.
And the tension goes far beyond unfair competition. By forcing stablecoins into this narrow banking model, the Genius Act created a massive macroprudential risk, tying the crypto markets directly to the U.S. sovereign debt market.
Here is where the architecture gets incredibly fragile, in my opinion. We set out to make digital dollars perfectly safe by legally mandating that they be backed by U.S. treasuries.
Yeah.
But the unintentional side effect is that we made the traditional treasury market deeply reliant on the stability of digital networks. I mean, stablecoin issuers are now holding hundreds of billions of dollars in short-term U.S. debt.
Right. And the immediate first order effect of that is yield suppression. Because these issuers are captive buyers, they are legally required to purchase these specific assets. They exert massive downward pressure on T-bill yields.
Wait, so they're basically helping fund the federal deficit on the cheap?
Exactly. They've become one of the most reliable buyers of U.S. debt in the world, which functionally subsidizes the federal deficit. The government is funding itself more cheaply simply because of stablecoin demand.
But here's where it gets really interesting and kind of terrifying. The Treasury redemption spiral.
Yeah, this is the dark side of that interdependence. Imagine a localized panic in the crypto markets that causes a massive redemption run on a major stablecoin. Let's say institutional users demand to redeem $50 billion worth of tokens for fiat cash over a single weekend.
Which happens in crypto.
It does. Because the issuer is primarily holding treasuries rather than physical cash, they are forced to liquidate tens of billions of dollars of T-bills on the open market in a matter of hours to meet those redemptions.
And in a thin trading environment over a weekend, a mass sell-off of that velocity could violently spike yields, right?
Completely destabilizing the global risk-free benchmark. Corporate payrolls, pension funds, standard bank collateral, everything relies on the predictable stability of short-term U.S. treasuries. A localized software panic could instantly translate into traditional finance liquidity crisis.
Wow. But the Federal Reserve has a mechanism to prevent this, don't they? According to the analysis, the Fed could just grant these stablecoin issuers skinny master accounts.
They could. That would allow the issuers to settle transactions directly in central bank money, drastically reducing their reliance on the commercial treasury market.
So why withhold that safety net? Why not just fix it?
Because the Federal Reserve is deeply concerned about disintermediated banking. If a digital stablecoin is backed directly by central bank money, it becomes the safest, most liquid form of money on the planet.
Oh, I see.
During times of economic stress, the logical move for any consumer or corporation would be to pull their cash out of commercial banks and just park it in stablecoins.
Which means your local traditional bank suddenly loses the core deposits they use to fund daily economic activity. If I move my life savings into a stablecoin for ultimate security, my local bank no longer has the capital to fund my neighbor's mortgage.
Exactly. The Fed is choosing to leave a systemic vulnerability in the Treasury market simply to protect the deposit base of the traditional banking sector.
That is wild. And because U.S. debt and the strength of the dollar are the foundation of the global economy, this domestic Treasury vulnerability directly impacts U.S. geopolitical strategy.
It does, which brings us back to the statistic you opened with the U.S. government stockpiling Bitcoin.
Right. In March 2025, Executive Order 14233 established the Strategic Bitcoin Reserve. Previously, the government treated seized digital assets like contraband, routinely auctioning them off to the public.
Yeah, and the research indicates they left over $17 billion in potential gains on the table through those liquidations.
The executive order halted that practice entirely, actively building a state reserve that now exceeds 328,000 Bitcoin.
If we connect this to the bigger picture, the mechanism behind this pivot is a direct countermeasure against de-dollarization. We're observing a highly coordinated effort by the BRICS plus nations, Brazil, Russia, India, China, and South Africa, to establish alternative payment rails and bypass U.S. financial hegemony.
Because they want to avoid American sanctions.
Right. They're seeking neutral, non-sovereign settlement layers to immunize themselves.
So by establishing a massive state position in a decentralized asset, the U.S. is essentially cornering the lifeboat. If rival nations attempt to use Bitcoin as an anti-dollar weapon to settle global trade, they're forced to use a network where the United States is the dominant institutional whale.
Exactly. It absorbs the anti-dollar liquidity and maintains U.S. influence over the alternative financial rails. But while the U.S. builds strategic reserves and wrestles with domestic bank lobbying, international competitors are actively deploying comprehensive frameworks.
Right, like the European Union.
Yeah, the EU's Markets in Crypto Assets Regulation, or MiCA, is fully operational. MiCA grants digital asset firms passporting rights, allowing a company regulated in one EU member state to seamlessly operate across all 27 nations.
That regulatory clarity is creating intense jurisdictional competition. draining engineering talent and capital away from American markets, which makes the current roadblock in the United States so critical.
Yeah, we have to talk about the roadblock.
Despite the OCC sprint, the Genius Act, and the Strategic Bitcoin Reserve, the overarching Clarity Act never crossed the finish line. In March 2026, the entire legislative process just froze in the Senate.
And the paralysis wasn't a result of substantive disagreement over digital asset policy. The administration issued an ultimatum tying all pending legislation to the SAVE Act.
Right, and just to be clear, we are simply reporting what the sources show here, not taking a stance on the policy itself, but the SAVE Act is a voter ID bill requiring strict proof of citizenship for federal voter registration.
Right, so by anchoring the legislative calendar to this highly partisan voter ID mandate, the progress on the Clarity Act ground to a halt. The prediction markets tracking the bill's passage collapsed to just 18%.
But it wasn't solely external political maneuvering that killed the momentum, was it? The digital asset industry kind of fractured internally, too.
It did. Brian Armstrong, the CEO of Coinbase, publicly withdrew his support for the Senate's version of the Clarity Act, which really stunned lawmakers who had worked on the bipartisan compromise.
And the dispute hinged on two specific additions to the draft. First, the traditional banking lobby successfully inserted a ban on stablecoin yield payouts, fearing that yield-bearing stablecoins would accelerate commercial deposit flight.
Right, and Coinbase generates substantial revenue through stablecoin rewards, making the ban an existential threat to their business model.
Then the second issue revolved around strict anti-money laundering rules, specifically targeting decentralized finance, or DeFi.
Yeah, industry advocates argued that applying traditional AML reporting requirements to decentralized protocols would essentially criminalize software developers who write the open source code.
It fundamentally breaks the privacy architecture of the network.
Yeah.
So the combination of external policy gridlock over the SAVE Act and internal industry fragmentation over yield and AML rules just created a perfect storm of stagnation.
It really did. But while human politicians deadlock in Washington and corporate lobbyists battle over revenue models, the underlying technology just continues to evolve.
Which brings us to the profound irony of this entire regulatory debate.
Right. The profound irony is that it operates under the assumption that the end user of the financial system is a human being.
Yes. The most paradigm-shifting insight in our source material is the transition toward agentic commerce. The Clarity Act and the Genius Act are structurally designed to protect retail investors and human corporate treasurers.
But the architects building the next generation of financial infrastructure are anticipating a system where the primary economic actors are autonomous artificial intelligence agents.
We're looking at advanced AI frameworks, such as NVIDIA's NemoClaw or the open-source OpenClaw alternatives designed to execute complex, multi-step workflows globally.
Consider an AI agent tasked with managing a global corporate supply chain. It needs to autonomously monitor inventory, negotiate freight rates with logistics algorithms, secure shipping containers, and execute cross-border payments 24 hours a day, 7 days a week.
And the legacy financial system is entirely incompatible with that operational velocity. Traditional finance relies on a T+2 settlement cycle, meaning a transaction requires 2 full business days to legally clear.
It's bound by manual authorizations, fragmented banking hours, and geographic borders.
Exactly. An AI agent operating at the speed of computation cannot wait until Monday morning for a wire transfer to clear before executing a time-sensitive supply chain maneuver.
It requires machine-to-machine payments. That is the ultimate utility of heavily regulated, fully backed stablecoins. They serve as the missing settlement layer for artificial intelligence.
By tokenizing the dollar on a cryptographic ledger, an AI agent can settle a transaction atomically. It can cryptographically verify that the funds are present and instantly execute a smart contract, completing the negotiation and the payment simultaneously without any human intermediary.
What's fascinating here is that the U.S. is designing regulations to protect human actors, missing that machines are the next wave. And if the United States fails to provide the legal clarity necessary for those blockchain rails to operate seamlessly, the agentic economy will simply build its infrastructure in jurisdictions like the EU that offer concrete regulatory parameters.
It's just wild. We've charted a massive transition today. We started in the chaotic environment of SEC regulation by enforcement and explored the mechanical sorting of the Clarity Act. We unpacked how the Genius Act forced stablecoins into a narrow banking model, igniting a turf war with traditional banks over franken-charters.
Yeah, and we examine the hidden systemic risks tying digital dollars to U.S. treasuries, the geopolitical chess game of the strategic Bitcoin reserve, and the political gridlock currently freezing U.S. momentum.
Finally, we arrived at the frontier of agentic commerce.
The frameworks debated in this 2025 to 2026 window aren't just resolving past disputes. They are actively laying the foundational concrete for the next century of automated global finance.
Which leaves you with a critical question to consider as you watch these markets evolve. We've spent decades designing financial regulations to protect human psychology, preventing bank runs, ensuring clear disclosures, putting up speed limits.
Right.
But if the future of global commerce is being custom-built for autonomous AI agents executing millions of instant machine-to-machine micropayments, at what point does human oversight of the economy become a structural bottleneck?
It's a huge shift.
If money truly moves at the speed of code, who is really in charge of the market? The regulators painting the lanes or the algorithms driving on them? Thank you for taking this deep dive with us today. Keep questioning the systems around you.